All right, everybody. Thanks for being here today. So we're going to cover the covered call strategy. This is going to be a multi-part video series. This was developed by me. This is certainly not the only way to do a covered call. It's one of the reasons we're going to have a series instead of a single video. So my name, Michael Bolin. For years, I've been using the screen name Signet. I'm the co-owner of OEC Coaching. And a little background, I started trading around June of 2018. And when I started trading, I went right into complex spreads, mostly because I didn't know how to do any form of technical analysis. And I had a day job where I couldn't use a computer or really be on my phone while I was at work. And if you don't know how to do technical analysis and you don't really have access to a lot of charts, then the kind of trading that you're going to be able to do is really limited. Now, back then, we didn't have the new futures products that we do now. We didn't have the Smalls Exchange or the Bloomberg FairX. We didn't have the micros. So futures were kind of off the table. And well, to trade those, you certainly need the ability to read price and perform technical analysis, and I didn't have that. And when you're trading spreads, you don't necessarily need to have that. In 2019, I got into stocks, and then later, when the micros did come out in the futures, I got into those as well, and I'm currently working on learning more about the Forex market. I worked at the Bullish Bears for over 42 months. I started out as a blogger, content creator, moved into live streaming, chat moderations. I represented the Bullish Bears at the Benzinga Options Boot Camp. So as a part of that, did webinars and presentations and really just about every aspect. If you have ever been over to the Bullish Bears, their next level library of advanced options educational content, that's mostly created by me. All right, so this strategy has a number of different parts, and we're going to kind of work through them in this order. 1, identify a market to trade. 2, focus on how we're going to accumulate stock. Now, just stop there for a second. Accumulate stock. Yeah, big fancy bank words. How are we going to get stock? How are we going to gather it, collect it, attain it? So, at any point during this presentation, if you hear me say words you don't quite understand, take the time to write them down, follow up, go to Google, type them out. In the options world, you're going to find a lot of words and phrases that kind of throw people off just because they sound complicated. And what you would realize if you did go search for those words and look them up, that they're usually some big fancy bank speak for something really simple. So don't let the big words kind of throw you off. We're going to talk about reducing the average share price, defending the position, and then growth. Now, we're not going to be able to cover all of these topics in a single video because I really don't want the videos to be really long. But this is what the video series is going to focus on. And it really starts with, what do you want to own? Some things to keep in mind with this when it comes to what you want to own. Make sure it's something that you actually like. I know that may seem kind of arbitrary, but For an example, I have an uncle that does not like Chevy. He's a mechanic. He was a mechanic his whole life. And as a family mechanic, he was the guy we all went to when something was wrong with our vehicles. And all of us knew growing up that he didn't work on Chevys. So if you wanted, the free mechanic in the family to at least take a look at your car and figure out what the problem was, you knew not to buy anything other than a Ford, or he wasn't going to help you. That may seem like a crazy little tangent, but when it comes to stock, if you're out there buying something and you don't like it, inevitably you're going to get rid of it. You're going to talk yourself out of it. You're going to decide, that you don't like the position at some point, and it's just not going to work out. Plus, a lot of trading has to do with reading, digging deeper, looking into things. And if it's something you don't like, you're not going to want to dig deeper, learn more about it. So try to focus on things that already match your interests, something you're interested in that you like. Maybe they make a widget or a product, or, it's something that inherently you find interesting or attractive. When it comes to what to own, we use this word widget in the trading world. What's their widget? Every company has a widget. It could be Netflix and their subscriber numbers. It could be AMD with new chips that they come out with, or Apple with their new phones and watches and tablets, Disney with theme parks and cruise ships. There's always a widget. What's their widget? If you don't know how to answer that question, you really don't know much about the company. Who runs that company? When do they report things? And I put the word things on there for a reason. There's so much more than just an earnings report. For an example, Apple just came out with their new iPhone 14 product series, and it's not earnings. They did that outside of earnings. In January, Target will report their Christmas sales numbers. In December, Walmart will publish their Black Friday sales numbers. And those aren't earnings dates, they're just reports. If you're going to trade something, you really want to know what the seasonal reporting period is for their widget, for whatever it is that they do. They're very likely going to have investor conferences. They're going to throw parties when they come out with new product lines. They're going to hype up their series, right? Their new products. You want to know when these things are going to happen. And that ties directly into any special events. It's also good to take a look at their earnings trend. A company that can consistently quarter over quarter over quarter grow, that's almost a unicorn trying to find this mythical growth creature that never has a bad quarter. But it should be trending in the right direction, right? Are they continuing to do good things quarter after quarter, moving in the right direction, good sales, good earnings per share, or are they really struggling, right? And sometimes those numbers aren't going to look very good, especially if they're growing, if they're expanding. Say they buy out a competitor and suddenly their debt ratio is just all out of whack. It's going to look bad at earnings. And yet they no longer have a competitor. So the possibility that the next earnings would look even better may be a good enough reason to forgive the current earnings numbers, right? So it's not one earnings. It's how are their earnings trending? Do they have a dividend? Who's the peers in this space? And that one can sometimes be a little bit of a surprise, right? Like in my house, we always talk about Walmart and Target. Well, Walmart and Target are not exactly the same thing. And if you were to look them up in their sector and their subsector, you'll see that they're not in the same group. So when it comes to peers, try to be exact, try to be specific, really understand who are the peers in this group. Say, for an example, you like an EV market or you want to get into an EV market space. The obvious name that comes to mind is Tesla. But Tesla is a very expensive company. Maybe you don't have the capital to own hundreds and hundreds of shares of Tesla, but you still want to get into the EV space. At that point, you could start looking around and thinking about other companies that do what Tesla does, right? Ride, Lee, Neo, even GM, Ford, Apple, and Google are getting into that space, right? Can you imagine owning an Apple car? That sounds funny now, right? In the year 2022, but who knows where we will be in 10 years? What's the long-term goal? Now, this one really comes back to you. What is your long-term goal? Are you going to hang on to these things forever? Maybe pass them down to the grandkids someday? Or is this just an opportunity trade where you see a particular name or sector or industry that's down on its luck and you're expecting a capital rotation? For an example, it's 2022. The S&P has been down, over 20%. We're technically in a bear market. Energy was doing really good. Tech was doing really bad. And at some point, we're going to rotate out of that. And we're going to see energy go back to being the boring, dull, low cap market space. And tech is going to be the dominant space again. What's your long-term goal with this trade? What's the sustainability, right? How are you going to be able to maintain this? Now, those last two, the long-term goal and the sustainability, that can be based on you and your perspective of this trade, but it can also tie directly into what you're trading. For an example, Apple, it's been around for a long, long time, or AT&T, been around for a long time. And yet there's names that are gone now that used to be real big in the space, like Yahoo. Yahoo stock was the darling of Wall Street for years and years. Everybody owned it. Everybody wanted a piece of it. It's gone. Doesn't exist anymore. And it fell from grace, and it fell for a long, long time before it was finally taken out. And every time it paused in that fall and it stabilized and it tried to rally, everybody thought that's the comeback. And it wasn't. And it just kept falling. You don't want to have a long-term plan in something that might not be able to sustain itself for a long period of time. Now, of course, anything can happen. Even names that's been around forever can be absorbed or they can go under. Technologies change and make things irrelevant that used to dominate a space. So there's nothing that guarantees that a company is going to be around forever. But changing innovation, constantly looking for new ways to adapt to their new environment, that's a sign of a company that's probably going to be around for a while. And then, of course, if they already have been around for a while. For an example, Ford. I'm sure you've seen pictures of the Model A Ford. Can you imagine a Ford car from 1910? How about from 2010? They've certainly adapted and grown and changed in the last 100 years. And then, of course, what's the ripcord? What is your line in the sand where you say, I can't take it anymore. I got to get out of this. The pain is too bad. They've crossed a line that I can't tolerate. Now, everybody approaches that number differently, especially in a strategy like this, where you can literally remove all risk out of the trade. Even if the stock went to zero, you still wouldn't have any risk. You can get there in a strategy like this. Of course, that doesn't mean we actually want to run it all the way to zero, right? When Yahoo was falling from its grace, I wouldn't have wanted to ride it all the way down. I would have wanted to just get the heck out eventually. But what is that limit for you? So on this what to trade argument, this is always where it's hard to quantify some of the metrics. There's just too many styles of trader out there. So some tips to kind of help you out is focus on what you know. I worked in the oil and gas industry for 20 years. I know that company. I worked in the steel industry for more than 5 years, and it tied right into oil and gas. So to me, it was just a transition of the same field. I worked with the same machinery, the same tools, the same kind of people, the same environment. I know that field. When I look at an oil and gas company, I understand what I'm looking at. I don't necessarily want to trade it or own it, but I understand it. You're going to find when you're doing the research side of what to trade, that if you focus on things you already understand, it makes understanding the company a whole lot easier. It doesn't mean that you can't look at things that you don't understand. You're just going to be handicapped trying to trade against everybody else who does know what they're looking at. Make sure it fits your budget. You know, if you get a long-term trade and it basically ties up every bit of capital that you have, that's not going to leave you any room to trade anything else. Are you really comfortable with not having any more capital to trade? Now, it's really a question to yourself, right? It's not for anybody else to decide. When you're looking at the companies, which one of them has long-term staying power? Like we talked about earlier. Which of them has a product that you're okay with? There's a lot of disruptor investors out there nowadays, right? And they'll buy into a company and buy enough of it to get on the board and then start disrupting it. Maybe pushing it into a green space, right? Or forcing it to change. If you fundamentally disagree with a company, are you really going to want to hold that stock over the long term? Are you going to want to be associated with a company that makes that particular product? And I'll use a common theme nowadays. Say it's Philip Morris, a smoke company. There's so many anti-smokers out there now. Would you be willing to own a company like that, like Philip Morris? And again, it's just a personal space, right? It's a personal preference. Maybe focus on something that's improving too, right? Which does kind of imply that it had been beat down for a little while. If it's had a beat down and now it's improving, then that might kind of fit the bill. We had a little bit of running around there. All right. Now, when it comes to beating down names, this is where you can sometimes find a company that maybe was down on its luck and has turned things around, or a company that had CEO issues and has turned things around. And there's a couple of examples to this. One that comes to mind is a pizza name, and I'm not going to say the name of the company, but there was a conference call and the CEO made just this completely outlandish racist comment, and instead of trying to just own it, he basically put his foot in his mouth and made it worse, a lot worse. And the stock went down drastically. Well, eventually he resigned or he got fired. They replaced him, and then they had to build that company back up. And they replaced him with a well-known CEO, an individual that had cleaned up a few other companies, and they really turned things around. And that company's stock price actually outpaced Tesla's stock through 2019 and right up into COVID. So, that's one example where you can find a company that's improving. It was already a good company. They just had a significant share price rebalancing because of some social issues. Their their product was still good. Their stores were still run effectively. Their sales were fine. Everything just turned around again. Another example of that would be Disney. So during COVID, Disney has all these cruise ships, and these cruise ships were nothing more than cost, right? And nobody was going on cruises. These ships needed to be maintained, they needed to be docked. It was just a big drain. Same thing with this theme parks. Disney's theme parks were just big money pits. But it had a lot to do with the fact that nobody was going to theme parks, nobody was riding in cruise ships. And one of the things that Disney started to focus on was streaming services, making content, becoming producers, right, on that media space, getting into streaming services for things like sports. So they turned things in a different direction, found ways to expand, and really just tried to get by until they could open up those other avenues. So when it comes to finding things that are improving, it doesn't necessarily have to be something like Boeing, where they had airplanes falling out of the sky and their stock collapsed. And they're still to this day under absolute scrutiny anytime a plane goes down. Or when Ford had those tire issues, right? Their Firestone tires, and their stock went down drastically until they finally turned things around. So when it comes to, a situation where you find a stock at a low price and it seems to be improving, that can be a great metric for, what's been improving. Now, here for an example is a deep dive that I did on Walmart. And it's been a while. I believe this was 2020, maybe 2021. And what I did is I went out and I aggregated a bunch of data and I put it on the chart so that every time I looked at this chart, I had all of this information. Now, I've done a video on how to do this, um, a couple of videos. And if you wanted to find that, you would just go to YouTube and run a search, Bullish Bears, how to do a deep dive. And you would get this video and a couple others where I performed the video and I walked through what I had found, how I set all this up, where I got the information from. And this isn't what you have to have. This is just an example of what I do when I'm performing a deep dive into a company that I'm thinking about investing in. So with this deep dive, you're going to want to look at things like their earnings statement, product reviews. You want to know who are the peers in the space that you're trading, either as a company or as a product. Now, if you think about that for a moment, we wouldn't normally compare somebody like Ford and Apple. And yet, in the product space, if we're talking about EV markets, well, Apple's just getting into EV markets. So we could compare those two. You want to think about their expansion plans. Have they mentioned anything about building a new factory, getting into a new space? How does the company respond to inflation? Has it been around during the last inflation cycle? How did they do? Where do they fit into that spectrum of all frivolous spending versus must-have staples, right? Like electricity. You're going to run your air conditioner. You're going to run your heaters. You're going to buy food to put on the table, no matter what the inflation is. But you might not go on an extravagant vacation or buy the latest and greatest TV during a high-end inflation environment. What's their supply chain look like? Now, that one, I always use Apple. Apple's famous for its supply chain. They took the entire supply chain under their control, and they keep a very tight rein on it. What kind of headlines do you find when you Google or when you search and do a deep dive on your company? What kind of comments are you hearing from analysts? Now, this one, I've gotten pushback from it, but you got to take it into context. I would never recommend that you go trade something just because an analyst says that it's a buy, especially if it's just the headline. But a lot of really good analysts will do a deep dive and they'll tell you the numbers behind their deep dive, what they looked at, how they came to that recommendation. And what you'll find is a lot of them will come up with a number that nobody else saw. We've seen this a while back in the later part of 2021 with an education company in China. An analyst did a deep dive and found that a lot of parents were just really, really unhappy with this company. And they weren't enrolling their children into this company. They were actually looking at new companies. And an analyst wrote this big survey recommendation and laid out all of the failings of the current company and then highlighted what the new company was doing better. And when that report was published, the company that was not doing good, their stock took a horrendous gut punch. So when it comes to analysts, just catching the headline is not enough. Really look into what they have to say about the company. You do have to be cautious because a lot of those guys, you know, they're like paid promoters, right? They're just going to do what they're told because the parent company sends them a check and says, write up a recommendation for this company. So, read what they have to say and then make an informed decision, not just looking at the headline. All right, so when we go out to a stock chart, you want to look at the candles and see if there's any really big unexplained gaps. And what I mean by that is if you see a gap in its earnings, well, I mean, that's understood, right? It had earnings, it gapped up or it gapped down. Or you see a big gap and it wasn't earnings, but you find out that they reported sales numbers. Okay, it's understood, right? It's an explained gap. What you don't want to see is just big random gaps all over the place for no reason. That should make you nervous. No big unexplained moves. Now, this one is something I've really recently added. I used to say no parabolic moves, but that doesn't really fit. We're looking for unexplained moves, especially in this meme state environment where short covering rallies can just rip a company in one direction really fast. I personally avoid any long-term investments in something that I think is going to be attacked by the meme crowd. Generally speaking, I'm not interested in getting into names that are heavily shorted by industry standards anyways, but some of those names can surprise you. Kroger, for an example, before Warren Buffett got into it, they hit that short interest list for a while, and they were on the Reddit boards. Of course, AMC and Bed Bath & Beyond, but what about Big Lots? They've been on the Reddit boards. They've been attacked by the memes crowd. So I changed my metrics on this that I don't want to see any unexplained moves. Usually those unexplained moves are some kind of short covering rally. I really want to see steady growth. Now, depending on the chart, how far back you're going, that might be hard to see. All right. But if you put it on a weekly or a monthly chart and you look at the last 20 or 30 years, you should see that it's been continuing to grow and expand. I also don't want to come across a stock that's been splitting, either reducing or increasing significantly. So for an example, Google stayed a very expensive stock for a long time before it split. And Apple and Amazon and Tesla all in 2022 had a stock split. And I think the last time Apple split its stock was 2019. But you'll find these companies that are offering shares, trying to raise capital because they're struggling and they just need the money. And maybe they're doing stock offerings because they have a bad credit rating and they can't get a good loan from the bank. So then they put out a lot of stock and then they come out with splits and they just, you want to avoid all that. So I don't want to see, when I look at a stock chart, a lot of splits. I want to see understandable price moves. So no big extreme sweeping directions back and forth. And I want to see healthy recoveries. Everything goes down at some point, right? Like when COVID hit, just about everything went down. And the names that bounced back the fastest were the healthiest names out there. Now, of course, the sector that they belong to had a little bit to do with that, right? Because again, restaurants and theme parks and movie theaters, cruise lines, airlines, depending on the sector, it didn't necessarily come back as fast. But airlines and cruise lines, but especially airlines, they're notorious for bad money management. And even to this day in 2022, the airline stocks have just not come back. They've got a bad credit rating. They're, again, notorious for mismanagement of money. They're just not good companies. That doesn't mean I won't trade them. But there's a difference between a trade and an investment. When I go to the options chain, I want to find consistent volatility. I want to see a reasonably decent beta. I want liquidity within the chain and within the strikes. I want to see active participants, and I want to see fair value. Now, I've got an example of that. So here we're looking at a strike, an options chain, and we've got $1 wide strikes, which is really nice. We've got a tight bid-ask spread showing active participation. We've got high open interest. We've got a reasonably decent extrinsic value considering the size of the stock. There are a lot of strikes to choose from. And when it comes to the open interest, it's not just one strike, but we're seeing a lot of open interest all across the place, all across all these different strikes. And when we look at the implied volatility, we're seeing a consistent level of volatility. That's what I'm looking for. Now, when it comes to getting stock, there's not a wrong way to do this, but there are a couple of consistent ways to do this. Depending on how soon you want to go, you may just all in. Suppose I wanted 10,000 shares of a company and I want them now. Well, there's not necessarily anything wrong with that. I could just buy 10,000 shares today. Boom, be done. I'm all in now. But every time I do that, it seems like I get buyer's remorse that inevitably within a week or two, I'm thinking to myself, I should have averaged in. Which brings me to dollar cost averaging. If I'm in a trade and the trade is losing, I don't add to a losing trade. I get out. I'm losing. But this is a long-term investment. And if I can buy it at a cheaper price, I will. I'm not looking at a trade and thinking, gosh, I'm losing. I'm looking at an investment and thinking, gosh, I have a chance to buy more of it at a cheaper price. If I didn't think it was going to go up in the future anyways, then I never would have started investing into this company. On that same note, when it comes to dollar cost averaging, you can do the same thing with put selling. So if the company is a $100 company and you're selling puts at $100, if you get assigned, you're going to get a $100 stock. But if you spread it out and you sell the 95 strike, the 105 strike, the 100 strike, then you're going to be collecting shares at a different cost. You'll end up with a dollar cost average position, 100 shares at a time. And then, of course, you can do a combination of all of those things. You could have a seed position that you started all in, and then you can dollar cost average at different levels while also selling puts. So if we were to average in by buying stock, I've got an example here of Ford. Suppose we wanted an average share price of around $18, and we bought 125 shares at $17.75. Later on, we bought some at $18.25, and then we bought some at $18, and we bought some at $17. We would then have a total of 500 shares, and we would have an average share cost of $17.63 per share. Now, I used this stock screener to get that cost. You don't have to do that. You can just kind of ballpark it. But that's what I came up with by using this website. It's free. It doesn't cost you anything. You can just go to that website, type in how many shares, at what cost, and it'll do the rest. It's very simple, easy to use. Now, here's another example. Ford stock. Suppose we sold the 17 strike put for $1.45, and later on we sold another one at $1.35, and then we sold another one later on at $1, and then we sold two of those when they were worth $2 a piece. And we end up with a combined credit of $7.80. And then we end up getting assigned later. Well, our average share price is not $17. It's $17 minus all that credit that we collected. $9.20 is our average share price. So to review these steps, when it comes to accumulating the position, your point of view is really important. You're going to be holding on to these for a long time. You kind of need to like it. I know it seems a little arbitrary, but if you don't like the company or if you don't like the position, you will talk yourself out of it. You need to clearly articulate what the plan is to get out. What if this company starts to go into the toilet? Whatever company it happens to be. It can happen to the best names out there. You don't want to go to zero. What is going to be your level that says, I've had enough, I can't take it anymore? And remember, it's not just about risk, because if your average share price is zero, no matter what you sell the stock for, there's a profit. It's just, when do you decide that enough is enough and you're finally getting out? Very often, it has nothing to do with the stock chart. It has everything to do with the company itself. So this would be a great time to stop the video. And when we come back, we'll go out to the stock chart and we'll take a look around and have this discussion about what we want to see within the candles to make a determination if it's a company that we think is worthy of an investment. And maybe some of the things that I like to look at and how my approach works when it comes to making this decision. So that's it for this video. I appreciate your time, and I'll see you at the next video.